And we're going to pick up on some of the themes that are already starting to bubble up in some of the conversations we've been having about corporate governance being a key issue in China, but particularly more broadly across other parts of Asia. And we've heard a range of insights about China, particularly concerns about transparency or maybe the opaqueness of business practice, cultural issues around how business is done and the importance of relationships, perhaps concerns about political influence over corporate behaviour. And we had a bit of discussion this morning, which we might ask Jamie to pick up at some point, about issues of how shareholders are viewed by Chinese companies. Also, I think there's been some underlying current about concerns about the high risk of corrupt business practices in China. We've got two speakers today, Jamie Allen and Michael Cheng. They're going to do a bit of a tag team. It's a bit of tap dancing between the two of you. Jamie Allen is Secretary General of the Asian Corporate Governance Association, and Michael is Research Director. Their profiles are in the back of the book, so I won't read them out in the interests of time. They're going to talk for about 35 minutes on corporate governance trends across Asia, some examples of good and bad practice, and some results of a survey that they've been working on. Then we're going to have a bit of time for questions, and then 15 to 20 minutes in your roundtable groups to have a conversation about some of these issues. Michael unfortunately has to leave after his presentation, but Jamie will be wandering around during the table discussions, so you'll be able to engage with him and get his insights a little bit more there, and also he's staying on for dinner with us this evening. So if I could now warmly welcome Jamie first and then Michael, and hand over to you.
Thank you, Angela. I'm sorry we're talking about such a serious topic, corporate governance, after lunch, but we'll try and keep it interesting for you. What I'm going to do this morning is, this afternoon, I must be more tired than you are, why corporate governance matters to investors in Asia. It's becoming an increasingly important issue. We founded our association in the late 90s after the Asian financial crisis. Back then, it was actually pretty tough to get investors to be interested in corporate governance. It's certainly got a lot easier over the last 5 to 10 years. We're going to talk about the regulatory context in Asia, some of the similarities and differences that we see in regulatory reform in the region. I'll give you an update on corporate governance reform over the past year or two. We've seen a new wave of reform coming through now in most of the region. There's actually quite a lot of initiatives being undertaken by regulators and others. Talk a little bit about the role of ACGA. We don't want to do too much of an advertisement, but just talk a little bit about some of the advocacy initiatives we've been working on in Korea and Japan. Then we'll give you our ranking of corporate governance in Asia. We do a survey every 2 years called CG Watch, where we rank 11 markets. This is where we become very popular with regulators. If we rank them up, they like us. If we rank them down, we often get summoned to their city to talk to them about what the problems are. And then the evolution of corporate governance in China. So why corporate governance matters to investors in Asia? Well, Asia is in transition, has been in transition on corporate governance since the Asian financial crisis. So there is an emerging corporate and regulatory landscape in the region. And investors are exposed not just to company corporate governance risk, which is often the focus, obviously, of portfolio managers and analysts, but very much regulatory risks, and we'll touch upon some of these today. But quite often investors find that when there's a takeover, a privatisation, a delisting, that they don't have the shareholder rights and protections that they thought they had. We had one of our UK members who's facing a situation in Singapore at the moment where one of their investee companies is subject to a takeover, which is going to go through a scheme of arrangement in Singapore. They are quite surprised that they don't have more shareholder protections than they thought they had. Large sums of institutional money clearly are coming to the region, are already in the region. As the region grows, this will increase. I think, obviously, you already know this. We see regular crises at the corporate level in Asia. We've had the Alibaba case in Hong Kong. where Alibaba wanted to list with a special partnership structure. We're happy to debate that later with you if you like. We're not big fans of this partnership structure. We think Alibaba should list in Hong Kong under our current rules, which are basically one share, one vote, allow fairness to and transparency to shareholders. Alibaba went through quite a long process of trying to convince the Hong Kong government and regulators and market it should be allowed to list with this very unusual structure. Fortunately, Hong Kong fought back over that. Unaudited financials at Korean companies is another issue recently that's been of concern to our members, where they're basically being asked before the AGMs in Korea to vote on unaudited as opposed to audited numbers. State intervention in SOEs in China, it's an ongoing problem. Obviously, you've discussed that in the last couple of days. But wherever you look in the region, whether it's state enterprises or private sector companies, there's a series of corporate governance problems that keep coming. So it gives us a lot of work to do. Actually, we'd slightly like to have less work to do, covering 11 markets, but there's clearly a lot of issues out there. And in corporate governance isn't just about, obviously, returns. That's an important part of it. But we believe that better governance leads to better decisions, better strategic decisions by boards on environmental and social issues. And one of the issues in Asia now is whether CSR sustainability is really just philanthropy, or whether companies are able to take a more strategic approach and really integrate that into their operations and into their strategy. Looking at the regulatory context in the region, when we founded our association back in the late 90s, before the Asian financial crisis, if you looked around the region and you looked for a code of corporate governance, which is by code of corporate governance, I just mean an aspirational document like the AIST principles, setting best practices for boards of directors. Basically, no market except Hong Kong had one. Hong Kong had a very small one. Independent directors, no market made that mandatory, and no market made audit committees mandatory. After the Asian financial crisis, you saw a significant change. You've seen all markets except Japan bring in a code of corporate governance. Many of the markets there have revised the code once, or in some cases twice. So the years there refer to the first code and any subsequent revisions. All markets except Japan require independent directors. All markets except Japan require audit committees. So if you can see a theme developing here, with Japan as the outlier, that's the correct interpretation. Japan, under the Abe government now, is actually looking at bringing out a code of corporate governance. It's going to be very interesting to see if that actually comes. It should be coming next month, hopefully. And they're also talking about mandatory independent directors. But on a basic level, Japan hasn't made the reforms that many other markets have made. Okay, looking at Asian differences. So in terms of board structure and a lot of the rules and regulations in corporate governance over the last 10 to 15 years in Asia, you do see a lot of similarities. You see a convergence around what you could loosely term as global best practices. But if you look at actual board structure, legal structure, you see significant differences. So the historic basis of company law, which sets the foundation for board structure in the region, comes from largely different European countries, England, Germany, Netherlands in particular. Board structure, you can see, varies a great deal. It's particularly complex in China because you don't just have a single board of directors, you also have a supervisory board, but it gets even more complicated because you have this thing called the party committee, which is a committee of the Communist Party senior leaders in a company, and not necessarily just in SOEs, mostly in SOEs, but also in some of the private companies now. And the relationship between the party committee and the board of directors is quite a complex relationship, and there's not a lot of information out there. So the relationship is being somewhat delineated in the past few years, but the problem for investors is it's a black box. You don't really know what the party committee is doing and how it relates to the board of directors. So it would be a wrong assumption in China to look at a board of directors and say it's making the sorts of decisions that boards in, say, Australia are making. Okay, one last slide before I turn over to Michael for a few slides. One way to understand corporate governance in Asia is to look at it as proceeding on diverging tracks. So one track is basically areas where international rules are dominant, because basically there is strong agreement and political support for a set of common standards to facilitate trade and investment. So you see common standards on accounting and reporting, standards and practices, organisation of shareholder meetings and voting, regulation of external auditors, and electronic disclosure. So these are some areas where people don't argue that one size doesn't fit all. They basically accept that one size largely does fit all. But local norms still dominate in many areas where controlling shareholders and vested interests, their interests prevail. So in terms of board operations as opposed to board structure, you see a lot of differences around the region. Dialogue with shareholders, the way companies will talk to you, whether they will talk to you at all, varies a great deal. And it doesn't just vary between markets, it also varies considerably within markets. The good news is that this does evolve. So in Korea, for example, 3 or 4 years ago, we found it pretty hard to talk to companies about corporate governance. If we wanted to talk about corporate social responsibility, they said, sure, no problem. And then we said, actually, we also want to talk about corporate governance. They said, please go away. And we said, well, we are the Asian Corporate Governance Association. And they said, well, we didn't know you wanted to talk about corporate governance. We thought you wanted to talk about corporate social responsibility. That's moved on in Korea now, where people are actually, companies are more willing to talk about governance. Decisions on related party transactions vary a great deal. This is partly due to regulation in the region, but also partly due to the culture of the company, the attitude. So you see a wide variation. You can see some state enterprises with reasonable governance or improving governance standards. You see even greater variation within the private sector, particularly family companies. So typically family companies are often quite antipathetic to shareholders, find it hard to trust outsiders, and are often opaque. But you see some family companies that are very open and willing to improve their governance. Okay, well, I'm just going to turn over to Michael now to talk about update on CG reform in Asia and a bit about ACGA. So Michael, over to you.
Thank you, everyone. Good afternoon. I cover China and Hong Kong. I am, by way of background, 100% locally produced in Hong Kong. I do a lot of work previously in mainland China. And let me now completely go off script. This is where we should get it interesting. Now, after a couple of days of learning more about China, we're physically in Shanghai, impeccable organization by AIST Secretariat. Amongst all of you, who feel more positively towards China after a couple of days of discussion? May I have a show of hands? Wow, I'm impressed, brilliant. And adding that further, whom of you feel more positively about Shanghai, particularly about Shanghai? Great, that seems to be also the vibe I'm also getting myself. ACGA, we led a delegation of global investors to 5 action-packed days in Beijing, Shanghai, and Hangzhou last year. And Jamie and I did a pre-trip back in, that was July, August, I think last year, Jamie? When our plane got diverted to Nanjing and we tried desperately urgent to get back to Shanghai the very same evening, and we finally did. But this time, we arrived also a couple of days ago, I feel that Shanghai is happening. China is happening. I don't know, by the show of hands just now, you all seem to agree with me. As I mentioned, I'm a Hong Kong local, and as we will see in this slide, and when Jamie gets to the CG rankings, Hong Kong has been ranking somewhat way higher than mainland China in previous surveys. We are obviously very objective, but on a personal level, my worry is Hong Kong is sort of deteriorating on some level on some of its best practices, while on the other hand, China is keen to catch up. And that dynamic, I'm very pleased to see by the show of hands just now, sort of consistent with that vibe. But before I get into more of that towards possibly the later section of our discussion, let me highlight some of that. I'm pleased to begin with China. And new IPO rules. The China IPO market was shut down for 14 months, can you believe it, from October 2012, and was just restarted in January this year. That conceptually, I don't know whether you agree with me, is counterintuitive. It shouldn't be what a free market should be doing, right? You don't stop new companies from listing in your market, right? That simply don't happen in Australia. So for mainland China, that's actually a very bad idea. It's traffic control. So you can't come into the market until the regulators tell you to or let you do it. So that's a bad idea, but they have their reasons, and the market's explanation very frequently is their way of weaning out bad applications and trying to avoid what they call a liquidity problem. The rationale being, if you allow more newly listed companies, the money go to the new IPOs, and for the secondary market, it's even more bad news when their index is struggling. So they finally ended that, what we call the moratorium over new listings in January this year. Again, they issue new rules, and it's a matter of speculation now whether they might have further so-called traffic control later this year. They also, last July, they had a piece of rather encouraging document by their banking regulator, the China Banking Regulatory Commission, where they issued a new set of corporate governance guidelines for banks. And it's very comprehensive, ladies and gentlemen. It has a whole lengthy chapter on shareholders' meeting, which I've never seen in a similar document of that nature, and that's very encouraging. Hong Kong. I've been a former regulator myself. If you look at my background, I've worked in an investment bank for a number of years, and then I was with the Hong Kong Stock Exchange as a regulator. And I often think, and I think some of my previous supervisors have said it well, regulators sometimes go left, over-regulate. Sometimes they go right, hope I get my direction right, be too permissive. And often the market thinks, why don't they just do nothing and stay in the middle, and the market would be better? Now, I give that dynamic because in Hong Kong, right now, the flavor of the month, the regulatory focus is on sponsors, on investment banks, helping companies to list in the Hong Kong market. And there's a lot of scrutiny, and I think it should be. ACGA has been promoting for a long time, and Jamie put a lot of effort into that on pre-IPO governance, and that makes sense. A lot of time, the best window of opportunity to improve a company's governance is when it prepares for an initial public offering. But that, unfortunately, isn't what is picked up by the regulators in Hong Kong. They are more focused on if there are problems when a company gets into trouble after listing, then the regulator thinks, well, we need to go after the investment banks involved. And right now, that appears to be the dynamic in Hong Kong. So we have new IPO rules. On a more positive front, there are new rules on disclosure on price-sensitive information in Hong Kong since January 2013. Now, unfortunately, Hong Kong does not have a good continuous disclosure regime as you have in Australia. So the new rules in 2013 finally codify into the legal framework the obligation to disclose price-sensitive information by listed companies, which originally was just a matter under the listing rules. So that's for Hong Kong. In India, we have the Landmark New Companies Act. I have to say, Jamie knows way more about India than I do. I just led an India delegation in February. Indonesia, we have a new regulator. Japan, we'll be talking more about that. Jamie just highlighted that previously. Korea, we had our annual conference last November in Seoul. And we do see a more open attitude towards corporate governance in Korea. Malaysia, Stewardship Code and CG Blueprint. Developments in Philippines, Singapore. Well, of course, I'm from Hong Kong. I need to point that out. Singapore will finally have voting by poll by August 2015. Hong Kong had that since January 2009. Taiwan, all the committees and independent directors finally going to be introduced in staggered manner. And Thailand, we have regulation of auditors and the new CG code. Okay, I'll just go over very quickly agenda for companies, but you can see the very different perspectives from as seen by the regulators and investors. So related party transaction, financial and non-financial reporting, and very important lately, executive compensation. Now, from the perspective of companies, they look at completely different things, and obviously that's not a surprise. I have to say diversity has been a key topic of discussion lately, but I think that dialogue is way more advanced in Australia. You've been talking about diversity in Australia for a long time. And it's not only about gender, it's also about diversity of perspectives, age, background, professionally and otherwise. And CSR, very important, environmental, social, and governance. And what's now the new trend is strategic, ESG or CSR. How does that relate to your company's strategy? Okay, just very quickly, Jim and I are here. We have to tell you about ACGA. So we're independent non-profit. Through advocacy, research, and education, we try to promote corporate governance developments in 11 markets in Asia. Our membership network, we have about 100 organizations covering global investors, pension funds, listed companies in Asia, and other intermediaries and universities, etc. Our institutional investor base, they manage a total of US 14 trillion globally. Okay, just some highlights of our members. Okay, well, we did something interesting this year. There is this challenge in Korea where global investors are asked to do proxy voting on the basis of unaudited financials. That may seem strange to you, but that's the practice in Korea for quite a period of time. So what we did, we coordinated 32, I think that broke our record for an exercise of this nature, Jamie. 32 members and signatories. We wrote to 26 largest Korean listed companies or companies with significant foreign shareholding. We pointed out that matter to them. We're glad to report quite a number of them have now already reported audited financials, and another bunch promised they will revisit this issue next year. And also very importantly, the investor relations people tell us, thank you ACGA for writing us this letter. That gives us the basis to go to management and say, hey, this is something you need to look at. And Jamie now wants to talk about Japan.
Thank you.
Thanks, Michael. Angela, I think it'd be interesting to ask Michael's question of your members again after your visit to Beijing next week.
Yes.
With Beijing's pollution, whether you're quite as positive about China as you do today. But,
We should have taken an actual count.
one issue we worked on recently in Japan was the Olympus case. It was a significant accounting fraud that you probably know about. It was hidden for many years. Michael Woodford, you've probably heard him speak at a conference around the world in the last 2 or 3 years. Basically, what the Tokyo Stock Exchange wanted to do initially, and there was a lot of pressure in Japan just to immediately delist Olympus because it had perpetrated such a serious fraud. We said to the exchange, look, that doesn't really seem to make a lot of sense to us. If you delist the company, it will not just damage the company, it will damage obviously the shareholder value of the company, it will damage the relationships the company has with its suppliers, it will hurt the employees. So we basically argue to the exchange, why don't you put it as a security on alert, which is something they can do in Japan, give it time to resurrect its corporate governance, rebuild its system, which it's been doing, and also then prosecute the senior managers of the company who had perpetrated the fraud. So we, again, this was a letter writing, we spoke to the TSE first, then we wrote a formal letter signed by many of our members and managed to help give the TSE a reason to not delist Olympus. When we wrote that letter, the share price was trading at a low of 650 yen. It's now 3,200 or thereabouts. Unfortunately, we're not an investment organization. Had we bought shares at that time, it would have been a pretty good return. But I think it shows that there is value in keeping companies listed, rehabilitating them, and not just sort of knocking them off the exchange. Japan, unlike Hong Kong has a very tortuous and slow delisting process. Japan actually has more of a US-style delisting process, which is much more prescriptive and quicker. Coming to our ranking, this is our CG Watch ranking, where we look at 11 markets in the region and we rank them on 5 different categories for corporate governance. And we've been doing this since 2003. And these are results of the last 3 surveys we did in 2007, 10 and 12. And we're now doing the new survey, which will be published later this year. But what you can see is Singapore, Hong Kong at the top, no big surprise there. Indonesia, Philippines at the bottom, probably no big surprise there. China towards the bottom, Korea towards the bottom. Probably a little surprised maybe by the scores that Singapore, Hong Kong get. Those are not great scores, 69% for Singapore, 66% for Hong Kong. If you also look at the amount the score has changed from those 5 years, it's not a significant change. So one of the conclusions of the survey is we feel that scores should be higher in Asia after 15 years of corporate governance reform. Singapore, Hong Kong are both international financial markets. We feel they should be higher than they are. Thailand came third, which you might be surprised about. The Thais were certainly very surprised about it. In fact, Thailand is the only market where we got criticised for giving them a high score, not a low score. But what we said to the Thais is, we're not saying you're good, because a score of 58% isn't very good. When I went to university, by the way, I'm Australian, but I've lived in Asia an awfully long time, so if I sound a bit English, that's why. But 58% is not great. We're simply saying that Thailand is better than all the markets below it. And we would still stand by that. Japan is improving this year, but it's going to be interesting to see how the scores and ranking come out. Taiwan fell in score. This was one market that got very upset. We were summoned to Taipei to speak to the regulator, speak to the stock exchange, and were grilled for a whole day on why the score was as low as it was. And we said, well, it's not actually that you're not making improvements, because they were making improvements. The problem is they were making improvements rather slowly. Other markets were making improvements much faster. So the scoring is not just whether a market has improved on the 2-year overview, but how they're improving relative to other markets. So that just gives you a sort of sense of where the rankings are. This just gives you a sense of the 5 different categories we look at. We look at rules, we look at enforcement, we look at political regulatory structures, institutions. That also includes the judiciary, it includes the media, and so on. IGAP is accounting and auditing, but it's not just standards, it's also practices. We look at account preparation by large companies versus small companies. One of the things in Asia is that smaller listed companies, you may or may not be surprised to hear, actually think the auditor's job is to help with account preparation. So even in Singapore, ACRA, the audit regulator, did a survey recently, and even they were surprised to find that about 25% of listed companies in Singapore said, yes, auditors should help with account preparation. ACRA said, no, you guys don't understand auditing. So this is a real problem for auditors, because auditors then have to spend more time on the pre-audit work, which they shouldn't be doing, which clearly makes it harder for them to do a proper audit. But we also look at the quality of audit, we look at the quality of auditors, we look at capacity within the industry, and a very big issue in Asia is really whether the audit industry has the capacity that you think they have. So that when you see a stamp from an auditor in a different market, does that stamp from a Big Four mean the same in Hong Kong, China, Malaysia, Thailand, India? It may or it may not. The question is, how do you know? If you don't talk to the auditors and get a sense of what's happening in those markets, you won't know. There is quite a bit of information out now from audit regulators, because we are getting a more independent audit regulatory regime in Asia, which is good. Quite a lot of interesting reports, particularly in Singapore, Malaysia, Thailand, on this very issue of the quality of auditors. Okay, and the last thing we look at is CG culture. That's really whether companies are making voluntary efforts, whether shareholders are engaged with companies, whether there's director training going on, and so forth. So the overall ranking is basically a simple average of those 5 different categories, and there's 90 questions underneath this survey, so it's a pretty detailed effort. We do it internally, we don't farm it out, because we find that if we farmed it out, people could answer part of the survey, not the whole survey. So we do it internally ourselves through a lot of research and interviews. Okay, Michael, over to you.
Okay.
The final point on CG reform in China.
Now in the sort of last section, before we go into a more interactive section, it's okay. So the rather challenging topic of corporate governance development in China. How did it all begin? Now, if we look at this sort of quick chart, which kind of has a span of about 12 years or so, you actually see that a lot of stuff began quite early in China. Now, independent directors, we just saw, even Japan right now did not have INEDs. China has INEDs since 2001, and 1/3 of the board for that matter. Hong Kong only managed to do that late 2012. So China was 11 years ahead of Hong Kong. 2002, they had that National Code of Corporate Governance. Hong Kong did not have our CG code until 2005. Quarterly reporting it took Hong Kong regulators 10 years to try to impose that requirement and still did not succeed. So before we get into over positive and robust feeling about, wow, isn't China corporate governance really great? The point that should sink in is for China, a lot of corporate governance initiatives are more form and substance. Now, we had a very interesting quote yesterday in one of the meetings we had, and I cannot attribute it to the organization. Sometimes independent directors in China, are they really independent? So the concept of independence in itself, when you have a market which is over 60% controlled by state ownership, the whole concept on independence is challenging. Are independent directors really able to exercise the check and balance as an INED? That is the question. So that's why similarly on quarterly reporting, also on the corporate governance code, it may be form over substance, and that not the true CG culture that we would like to see. And that is precisely why in the last slide Jamie showed you, China got a low score on CG culture when they had all these requirements that look really appealing but didn't have the substance. So sort of we fast forward there, as I mentioned in 1.3 we have the CBRC guidelines. Hopefully some of you will have the opportunity to engage with some of the listed banks from China, and one question or a series of questions you can discuss with them is their response to this new CBRC guidelines. Okay, now a sort of key vibe we've been getting lately, China leaders seem to be moving towards a more market-oriented, market-based system. Now with that, perhaps they are moving towards a more US-style registration or disclosure regime. And with that, we understand they would like to step up on enforcement. So regulators want to be seen to be tough. They are beefing up their enforcement personnel. So we are understanding that they are aiming for a big increase in enforcement staff. You see some test case, like the China Everbright case, but that is now a subject of litigation. Now the IPO moratorium I've discussed, that ended, but despite more new regulations, challenges remain. Even this January, as I mentioned, when the IPO market restarted in China, some deals were pulled, some deals were introduced, but with somewhat counterintuitive dynamics. So it looks like it still might take a bit of time before the China market can really develop towards a truly market-oriented regime. Foreign investment, they do want you all to go and invest in China. They would like also to see domestic institution the other way around, go out and make overseas investment. As I mentioned, they are looking at their CG code now, and there would be more focus on ESG or CSR issues. Now, for our last slide, the way forward, what do we see with a way to the future? The China leaders seem to be really keen on financial reform. So that may be interest rates, capital convertibility, QV and RQV quotas, attracting foreign investment. Now all of this, if we may say, may not impact corporate governance directly, but hopefully indirectly it will. Hopefully it puts more pressure on the players in China and the regulators towards learning more from the Western and international best practice in corporate governance. We've been asked before, Michael, how do you see CG reform or state-owned enterprise reform, which seemed to be a recent hot topic taking place? And I would say, probably quoting someone here, Darwinian. It's going to take an evolutionary approach. It'll get there eventually, but it'll take a bit of time. That seems to be also the approach that the China leaders are adopting. So on state-owned enterprise reform, what we see are not any initiatives directly requiring state-owned enterprise to do this or to do that. Rather, they encourage private enterprises to grow, and then indirectly put pressure on the SOEs to improve or otherwise be put out of competition in the market. So that's what I mean by indirectly, that's what I mean by an evolutionary or Darwinian approach. So again, going abroad, as I mentioned, China right now doing a lot of M&A overseas, so they need to comply with overseas laws and regulations in their reps and warranties, in legal contracts. They need to deal with a lot of overseas legal requirements. So that, again, simply impart or convey a very important message to the state-owned enterprises and their management. You have to be, in order to be successful, you have to improve. You have to adopt more international best practices on corporate governance in order to survive and thrive. And whether they will deliver, I leave it to you all for your own judgment, for you to observe in the days and months and years to come. Please watch this space, and I look forward to further discussing with you on these matters, hopefully not in the not too distant future.